Hello everyone and welcome to French Tax Online. My name is Géraud and I'm a French chartered accountant. Don't forget to hit that subscribe button and ring the notification bell so you never miss out on our latest video. Today, we are going to tackle a subject that is much more complex than it may initially seem, but one that raises a lot of questions: tax residency. The goal of this video is not to tell you what your tax residency country is, but rather to provide you with all the necessary tools to understand your situation. Indeed, while tax residency is straightforward for many of us, others find themselves in real gray areas for which no clear and definitive answer can be given. The basic definition of tax residency is given by Article 4b of the French General Tax Code, CGI, which deals with the concept of tax residency for individuals. This article outlines the criteria for determining whether a person is considered a tax resident in France or not. Here is a simplified translation of the main point of this article. This article establishes that individuals are considered to have their tax domicile in France if they meet one of the following conditions. They have their principal residence or place of habitual abode in France. They carry out a professional activity in France, whether employed or self-employed, unless this activity is carried out on an auxiliary basis. They have the center of their economic interest in France. It is important to note that the combination of these criteria determines a person's tax residency in France. If a person meets any of these criteria, they are usually considered a French tax resident and subject to income tax in France on their worldwide income. In the case of residency in two different countries, it is necessary to apply different criteria in succession to determine the predominant country. Please note that only one criterion is sufficient to be considered a French tax resident. Principal residence. The concept of the principal residence is essential in determining a person's tax residency in France. It is based on the notion of the usual place of living and often involves family consideration. The principal residence is defined as the place where a person habitually lives with the family. It is regarded as the focal point of family and personal life, typically being the primary residence where the person spends the majority of the time and maintains the strongest family ties. The principal residence is often closely tied to family life, considering not only the person's residence, but also that of their family, including spouse and children. Habitual residence is a key concept here. It is not just a temporary residence, but where a person regularly establishes their domicile. This can be influenced by factors such as the duration of stays, the presence of family, and other commitments. The determination of the principal residence is made by assessing where the person has established their center of habitual life. If this place is in France, the person is considered a French tax resident, even if they have other residences elsewhere. The criterion of center of economic interest is an essential aspect of determining tax residency in France. It is a broad criterion that considers the location of economic activities, both professional and financial. If the majority of your professional activities are carried out in France, it can influence your tax residency. This includes the location where you conduct your profession, whether you are employee or self-employed. For example, if your business is established in France, your main clients are in France, or your usual workplace is in France. This strengthens your economic connections with the country. Financial aspects are also taken into account. If most of your income, investment, or financial transaction take place in France, it can play a role in determining your tax residency. Bank account, investment, and other financial transactions can be indicators of the center of your economic interest. The location of your assets and wealth can be a factor too. If the majority of real estate, for example, is located in France, It also strengthens your economic connections with the country. Active participation in the French economy is a crucial element. If you play a significant role in the economic development of the country, whether through your professional activities, investment, or other economic contributions, it can influence your tax residency. The criterion of the main place of stay is an important element in determining a person's tax residency in France. Unlike the principal residence, which focuses on habitual family life, the main place of stay looks at the physical location where a person resides more frequently. The main place of stay is defined as the place where a person resides regularly and frequently. This is where they spend the majority of the time, even if it is not necessarily the habitual domicile. This criterion takes into account the physical reality of stay. The frequency and duration of stays are key elements in evaluating the main place of stay. It is not just an occasional stay, but rather where the person regularly establishes the residence. The repetition of stays is therefore an important factor. The main place of stay may be different from the principal residence. While the principal residence is related to habitual family life, the main place of stay focuses more on the physical location of the person, regardless of the presence of family. Interaction with other criteria. The main place of stay is often used in conjunction with other criteria, such as the principal residence and the center of economic interest to determine tax residency. These combined criteria offer a more comprehensive perspective on the person's situation. The very famous 183 days rule comes into play in the context of the main place of stay. If a person stays in France for more than the 183 days in a calendar year, it can influence their tax residency in France, even if other criteria are not fully met. Evidences. The determination of the main place of stay can be supported by evidences such as electricity bills, lease agreements, bank statements showing local transactions, etc., etc. The criterion of nationality. If none of the previous criteria could determine a clear answer regarding a taxpayer's tax residency, then the very last criterion to apply will be that of nationality. Thus, the taxpayer will be considered a tax resident of the country of which they hold nationality. Specific rules regarding tax residency. Some individuals may find themselves in specific situations regarding tax residency and may not be considered French tax residents even if they meet the criteria. Foreign civil servants and diplomatic agents may be subject to specific rules due to their particular status. They may sometimes benefit from tax exemptions under international agreements or diplomatic conventions. Posted salaried workers may also be subject to specific rules under bilateral agreements or tax conventions between France and the country of origin. These agreements may define the duration during which the posted worker remains a tax resident in the country of origin despite being present in France. Foreign students may benefit from tax exemptions as well, especially if they reside in France only to pursue their studies. However, certain conditions must be met, and there may be restrictions based on the duration of studies and other factors. International artists and athletes may be subject to specific rules due to their itinerant nature and income generated abroad. Specific agreements may govern the taxation of these professionals in France. Finally, cross-border employees who reside in a neighboring country while working in France may benefit from specific rules. Tax conventions may govern the situation of these workers to avoid double taxation. Tax residency for mixed couples, meaning couples composed of partners living in different places, can be complex. In France, tax residency is determined individually for each member of the couple, even if they are married. Here are some important points to consider. Each spouse is considered individually to determine the tax residency. This means that even if one spouse is a French tax resident, the other spouse may be a tax resident of another country. General criteria such as principal residence, center of economic interest, and the main place of stay are assessed for each spouse individually. It is then possible for both spouses to have different tax residency based on their own circumstances and activities. For example, if one spouse works in France while the other works abroad, their tax residency could differ. As the consequences, each spouse must file their own tax return based on their own tax residency. The income of each individual may be subject to taxation in the country where they are considered tax residents. This couple may benefit from provision in international tax treaties that govern the allocation of taxation between the countries involved. These treaties can help avoid double taxation and provide specific rules for determining the predominant tax residency. I hope you are still with me despite the information overload. You now have more tools to understand the concept of tax residency and determine your own country of residence based on your situation. I hope you liked this video. Please do not hesitate to reach out to us if you have any questions regarding your tax residency situation or your French income tax return. I wish you all a very good day and see you soon. Thank you very much.